Hello, students. I am going to take a few minutes to go through chapter 11, walkthrough. Share my screen. All right. So again, in chapter 11, we're looking at cash flows for businesses. So we're looking at relevant cash flows. We're looking at capital budgeting cash flows. How do we handle risk? Some of this stuff is going to be similar to what we've done already. Some of it will be a little bit different, and some of it will be entirely new. But what I've done is I've went through and I've grabbed questions that you will see in your homework, quiz, and exam, or this one I think was just in the homework and quiz. It kind of depends on, that there's an algorithm that selects your questions. I select generic ones, but they do ebb and flow for students. So some students may get 2 of these questions. Others might just get a single one. So again, I just want you to know that this isn't a static environment. This is my best guess on some of the more challenging questions that I just want to walk through and show you how to do. So again, relevant cash flows. I found this one in the homework, the quiz, and the exam, different variations of it. But if we're doing let's say we're a cereal company, and we're dealing with a little bit of uncertainty. We're looking to start a new product line, and we're estimating that the sales for the new cereal will be 25 million. 35% of those sales, though, will come from our other cereals. So we're cannibalizing some of our consumer base, but we're going to need to figure out, well, then what's our actual sales revenue level? It's not 25 million because we're going to have a reduction in force a little bit here. So I put in the relevant sales level formula. So it's sales for a new product minus sales taken from the other product line. So again, we just say, all right, our new sales appear to be isolated at 25 million. The percent that we're possibly going to lose is 35. And sales taken is just simply this times this. And then we just subtract this number from our 25 million. Okay, so that's really pretty simple, in my opinion. It doesn't take very long to figure out, but we started with our base. We are going to lose, to gain that 25 million, we're going to take 35% of that from the other category of crunch stuff and stars. So the sales taken from that group is here. So we really, even though we have new sales of 25 million, our relevant sales level for our new product is only 16.25 million, which is still a good margin. The next one is risk-adjusted discounted rates. I found one like this in the homework and the quiz. So what I did with the first pop-up window is this right here. Okay, so I just copied it. When I clicked on that, there's an option to copy. I copied it there. This one is this piece here. Now I want to be clear. There are 4 rates of return here, but only 2 of them matter. Okay, and we have to figure that out in the question. So we're looking at 2 capital budgeting projects. So we have Project A, Project B. The initial investments for Project A are $240,000. Here are our subsequent cash flows. Project B is $380,000 to start, and we have a repeating cash flow as we go along. So we have to figure out the net present value, and we've done net present value calculations in prior chapters, in chapter 10 particularly. But when we look here, the purpose, risk classes, and pre-assigned determined each project one. So I'm going to put the net present value here, and here's the formula. And the reason we see this, the first project, Project A, is replacement project. So we have to select the appropriate rate of return. So we use equals net present value. It tells us to get our rate. That's our required rate of return. We grab our cash inflows for the first 5 years, close the bracket, and then we add the we have to find for Project B is a project unrelated to current operations. So we need to use this one. Your question could very well say R&D operations. Okay, so you might have to select this one, but it's the same formula from the Project A to Project B. And based on this, the first part of the question is determine each project's risk-adjusted net present value. We've done that. Now, I believe there's some follow-up like Part B, Part C. If we had to choose one or the other, we would choose the one with the higher net present value. If we could choose multiple projects, we would choose the highest two, which in this case would be both of them. We would select because their net present value is positive. Real options in capital budgeting. Again, found one like this in the homework and the quiz. So we've come up with a new restaurant idea, Tex-Mex Thai Fusion. I'm not sure that sounds any good, but for the question, we're going to stick with that. We have our initial outlay of $5.7 million. Okay, so that's a negative. You also estimate there's a 50% chance that the new restaurant will be received and will produce annual cash flows of $840 per year forever. And there's a 50% chance of producing only a cash flow of only $180 per year forever if it isn't received well. So I put 50% probability or weights here. All right. The NPV is required rate of return to use the discount for the project is 11%. So I've got that here. Annual cash flow, $840. Annual cash flow 2, $180. So what we do next is the same thing we did at the prior one. We're going to determine our net present value, but we're not going to use the NPV. We have to use this formula I dropped in here. We have to figure out our free cash flows. Since it's a perpetuity, the assumption is that there is no close date to this restaurant, and so we have to figure out what our future cash flows, what their net present value is. And so to do that, free cash flows divided by the rate of return or cost of capital, that's our discount rate, minus our initial cash outlay. So that's exactly what I built in here. I took the free cash flows, 840 divided by the 11%, and then plus the initial outlay. We see the net present value for that one is positive. This one is a pretty massive loss if we're looking at it. What we have to do at this point is now we have to consider the probability or the weight. And so we just take both, each one times the 50%. And that gives us a negative expected net present value. However, here's the thing. These questions can have a follow-up. The first one that I looked at, this one did not. But explain why the project may be worthwhile, even though it has an estimated, just estimated that the net present value is negative. Well, what if the restaurant's successful and we could add 20 more restaurants or 10 more restaurants or 50, who knows? That is, if we are successful, but even though this is weighted at 50-50, the cash flows are quite large at that point. So what we have to do at this point is this one, as you can see, well, let's say we wanted to add 20 restaurants with that net present value calculation. So we'd have to take that basically 2 million times 20 restaurants. So each restaurant, their net present value would be almost 2 million. We multiply that by 20. And then for this one, it's exactly the same, because if it's not successful, we're going to stop after one restaurant. We're just going to cut our losses and be done. But this dramatically, right? You can see here, dramatically changes the net present value when you add more revenue producing cash flow restaurants. But what we have to do here is to figure out the expected net present value now is we have this amount. And since we've already probabilitied the weight, we just take this by 20. We don't have to do it again. And then we have to multiply our loss by half yet again, because we're just not going to stay there. And we would see that our expected net present value now, if we're successful, is $17 million, give or take. That is a dramatically different story than here. So on the off chance that we perhaps don't make it, this cash flow is a lot less than this one. So, but the initial outlay stays the same. We would be out maybe $4 million after 1 year if the restaurant fails. However, if we are successful, we see a much different story between the probable cash flows. You will most likely run into something like this, so take your time with that on the exam, Okay, I saw it on a couple different renderings of the exam, but I'm not sure if you'll see it. But just take your time with that. Think back to this note and come back to this part of the video to rebuild that. Risk-adjusted net present value. I saw this a couple of times. So what we do here is we've got our corporation, and just like above, we have project A, project B, and our years. Both require initial outlays of $11,000. We see that here and here. They'll operate for 5 years. We see that here. Okay. Now, project A is going to have $5,000 annually, and project B is going to have $6,000 annually. The only main difference here is the required rate of return is 15% for project B and 7% for A. So again, this is just like the one above right here. We just have to go back through and do our net present value calculation, where we take net present value, our rate, our inflows, close it, plus our outflow, and we see that project A is 9,500, despite having lower cash flows. The thing that's eating up project B is the discount rate. That's our required rate of return. It's chewing us up pretty bad in terms of our ability to mitigate expenses, whether that be through debt financing or some other variation, but we're looking at a pretty hefty 15% discount rate. So what we see is project A is going to have a higher net present value, but B is still positive. So it's not like it's a loss, it's just less than project A. This one I saw on the homework quiz and exam. So it's pretty straightforward though. I put the formulas in here. To figure out operating cash flows, we've got to figure out the change in our EBIT minus taxes plus depreciation. And that's where we kind of step through the process here. Okay. So in the question, we have revenues of $2 million identified here. We got 3 years. Now this is going to be a little different. Year 1, and then years 2 and 3. There's a delineation in the question here because we're going to go ahead and take all of our depreciation in year 1. So that creates a different layout for year 1 than it does for the other years. We see that our fixed and variable costs are $900,000. And for this first, I'm just putting in the puzzle pieces at this point. Here's our depreciation, and then we have our marginal tax rate identified at 24%. So let's go through and year 1 change in EBIT. The formula is earnings before interest and taxes. So that's the $2 million minus our taxes. Okay, we're gonna actually let's jump to the change in EBIT. So we take our revenue minus our fixed variable cost minus our depreciation. So it's actually 0 this year. We broke even. So that also means we're not going to have any taxes because our earnings before interest and tax, because of the depreciation, is 0. Now, where this changes in year 2 is we no longer have that depreciation. Okay, so it's still it is still the revenue minus the fixed cost. Whereas year 1, we took out the depreciation. Now we would have got that back on the cash flow statement, but it basically saved us being taxed on that $1.1 million. So change in EBIT. So we start here, revenue minus fixed cost, depreciation is wiped out now. Change in taxes is now we're being taxed on this $1.1 million at 24%. And then that leaves the difference between $1.1 million and the $264,000 in taxes. Okay. So that gives us what we need in the end. We have our change in EBIT up here, minus our taxes. We don't have we already took care of our depreciation. So our operating cash flow is $836,000, years 2 and 3. All things being equal, nothing changes over time or anything like that. So those are the main questions that I saw that would different variations on the homework and the exam. Those were the main ones for chapter 11. So what I will do here, I'll get this posted, and please let me know if you have any questions. Thank you.